But Bitcoin, on the other hand, Bitcoin measured from the 2019 low around 3,200 up to that 10,500 peak in February 2020. So that's more than a 200% run. And then, of course, after the COVID crash, Bitcoin went on to do roughly 300% just in 2020 alone. And then, of course, you have Bitcoin. That's the cleanest signal of all. From March 2020 COVID low, around 4,000 to 5,000, Bitcoin ran about $29,000 by the end of 2020. So that's a 300% return in that year. Then in 2021, it ran again to about $69,000 at the peak. So from the COVID panic low to the November 2021 high, you're talking about a move on the order of 1,200%, right? In less than 2 years.
When the Fed injects liquidity, markets surge. Stocks, tech, gold, and Bitcoin all rise, each at its own pace. Mark Moss explains that when liquidity returned to the markets after a period of tightening, assets across the board responded strongly. He points out that from early September 2019 to February 2020, the S&P 500 rose roughly 16.5% from pre-COVID levels, and even more, around 18.5% if measured from the October 2019 low. The NASDAQ, being more sensitive to liquidity, jumped about 25% in the same period. Gold also benefited from the shift, gaining around 17 to 18% in 2019, while Bitcoin surged over 200% from its 2019 low to its February 2020 peak. Looking at the period from 2020 to 2021, Mark Moss highlights the impact of the Fed's full-scale liquidity push. During this time, the Fed's balance sheet expanded dramatically from about $4 trillion at the start of 2020 to nearly $9 trillion by the end of 2021. The result was a massive surge in asset prices. The S&P 500 gained 18% in 2020 and another 28% in 2021, while the NASDAQ grew roughly 90% cumulatively over the same period. Gold pushed up another 25%, reflecting its role as a hard money asset, while Bitcoin offered the most extreme move, climbing from around $5,000 in March 2020 to roughly $69,000 at its peak in 2021. Mark Moss concludes that these patterns illustrate a clear playbook. When liquidity is injected into the system, risk assets and inflation-sensitive stores of value benefit dramatically. By examining 2019 through 2021, he argues that the same dynamics are likely to unfold going into 2026 and 2027, albeit from an even larger starting point. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Now, what happened to markets once that liquidity came back in? That's the important part that we want to know, right? We want to know what happens in 2026, what it has in store. So if we go back and let's look at the S&P 500. So if you anchor it from, say, early September 2019 into the pre-COVID peak in February of 2020, the S&P went up about 16.5%. Now, if you take it from the early October low to that February high, it's closer to about 18.5%. Once the Fed flipped from draining liquidity to adding liquidity, stocks went much higher. Now, if we look at the NASDAQ, which is, way more sensitive to liquidity, from early September 2019 to, again, February 2020, the NASDAQ went up 24.7%, about 25%. So if you go from early October low, right, it's about 27.5%. So QT ended, the Fed starts buying T-bills, the balance sheet quietly expands, and in that 5 to 6 month window, you get roughly 17 to 19% on the S&P 500, roughly 25 to 28% on the NASDAQ. But what about the debasement hedges, right? Now, gold had already started moving before that. For the full year of 2019, it was about $1,290 an ounce, and it went up to about $1,500 an ounce by December 31st. So about 17 to 18% gain for that year, going into early 2020. Now, it continued grinding higher towards about the 1,600 area. So gold responded to the shift in policy just the same, but in a little bit slower, more old school way. But Bitcoin, on the other hand, Bitcoin measured from the 2019 low around 3,200 up to that 10,500 peak in February 2020. So that's more than a 200% run. And then, of course, after the COVID crash, Bitcoin went on to do roughly 300% just in 2020 alone. So when you put it all together, here's what the 2019 playbook really looks like. August 2019, QT ends. August, September 2019, the repo markets blow out, rates spike, QT ends. October 2019, Fed announces $60 billion a month in purchases, and it's not QE. But from that period into February of 2020, the pre-COVID crash, S&P up about 19%, NASDAQ 28%, gold 18%, and Bitcoin was up nearly 200%. Different assets, different magnitudes, but all from the same driver, right? Once the Fed stopped shrinking the balance sheet and went back to growing it, liquidity improved. Risk assets, they responded. And of course, then COVID came out, right? It came out of nowhere, apparently. It interrupted that entire move, which is why I stopped all my comparisons at February 19th of 2020. But what we care about is the part that's comparable, right? QT ends, the plumbing breaks. The Fed quietly restarts balance sheet expansion. Markets treat that as a green light. And by the way, real quick, if you want to be ready for this next cycle, what's going to happen in 2026, not just watch it. I'm hosting a live virtual Wealth OS Accelerator live virtual event January 7th through 9th. We're going to build your full wealth engine together, workshop style, so you're ready for what's coming. Now, if we zoom out and we use 2020 to 2021 as the real analog, what do the next 2 years looks like, right? What happens when the Fed fully turns the hose back on? Because 2019 was when the regime change happened, right? From tightening to easing. But 2020 and 2021 were the 2-year results of that regime change. So now, just like I had to caveat before, that we have to keep in mind, right? This all gets somewhat distorted because of that COVID crash. But the Fed's balance sheet went from roughly $4 trillion at the start of 2020 to about $7 trillion by June, and then almost $9 trillion by the end of 2021. Now, look at what happened to asset prices in that environment. The S&P 500 was up 18% in 2020, another 28% in 2021. Back-to-back years of roughly 18 to 28%. And this is while the real economy was all over the place, right? Small businesses were getting shut down. Now, the NASDAQ did even more. In 2020, the NASDAQ was up around 48%. In 2021, it added another 27% on top of that. So in the 2 years where the Fed balance sheet basically doubled, big tech and growth stocks gave you something like 90% total returns. Gold pushed another 25% in 2020. So as the Fed was pushing trillions into the system, the classic hard money asset, it broke out to new all-time highs. And then, of course, you have Bitcoin. That's the cleanest signal of all. From March 2020 COVID low, around 4,000 to 5,000, Bitcoin ran about $29,000 by the end of 2020. So that's a 300% return in that year. Then in 2021, it ran again to about $69,000 at the peak. So from the COVID panic low to the November 2021 high, you're talking about a move on the order of 1,200%, right? In less than 2 years. So these are all different assets, but the same environment, right? When the Fed explodes the balance sheet, liquidity floods the system, and anything remotely sensitive to liquidity and debasement rips higher. Here's why I'm walking you through those numbers, right? We're setting up for the same version, right? The same playbook, right? Going into 2026 and probably 2027, but on top of a much bigger starting point.
Mark Moss explains that by late October, it became clear the Fed would need to stop quantitative tightening by December 1st. Since 2022, the Fed had reduced its balance sheet from about $8.9 trillion to $6.6 trillion, tightening reserves and straining funding markets. Repo rates began drifting above the Fed's target range, and banks increasingly relied on the standing repo facility, with usage reaching levels not seen since the pandemic. Fed officials, including John Williams and Lori Logan, publicly acknowledged that the balance sheet would need to grow again if reserves continued to fall, showing that the decision to halt QT was driven by the mechanics of the system rather than economic stimulus. Mark Moss highlights that once QT ended, the Fed immediately began adding liquidity through overnight repo operations, signaling the start of the next phase. With reserves scarce and short-term funding under pressure, the plumbing of the financial system was showing signs of strain. The Fed's intervention aimed to stabilize money markets, prevent spikes in overnight rates, and ensure banks had enough reserves to meet their obligations. This careful balancing act laid the groundwork for smoother market functioning and set the stage for broader asset price responses once liquidity returned in full. Let's get back to the interview.
So if we look back on October 29th, after the FOMC meeting, Powell said that the Fed would stop quantitative tightening on December 1st. Now, that was the official plan. On November 12th, New York Fed President John Williams, he confirmed it again. He said the committee had decided to conclude the reduction of securities holdings on December 1st. Now, when you look at the balance sheet, you see why they were done, right? Since 2022, the Fed has tightened or reduced total assets from about 8.9 trillion down to roughly 6.6 trillion. And once December 1st hit, the balance sheet basically flattened, right? The runoff completely stopped right there. But what really caught my attention was what happened immediately after. Because on the same day, December 1st, the Fed came in with about $13.5 billion in overnight repo operations. Now, this shouldn't be a big surprise, right? The Fed has been hinting that they're going to do this for months. We saw Williams talked about repo rates drifting higher, more use of the standing repo facility, and the Fed funds trading near the top of the target range. Now, those are the signs they watch when reserves start getting scarce. All right. Now, Lori Logan at the Dallas Fed spelled it out even more clearly. What she said was if repo rates keep rising, the Fed would need to start buying assets again to prevent reserves from falling too far. Now, Powell also said the same thing, right? He said at some point, the balance sheet is going to have to grow again to match the liabilities in the banking system. All right. So when you line it all up, right, the picture becomes pretty clear. It's pretty simple. They drained around $2.2 trillion in reserves. The reserves got tightened up, all right? The market starts signaling and it started flashing. And by the time December 1st came around, by the time it arrived, they had to stop the runoff, right? They had to start adding small amounts of liquidity back into the system. All right, now the reason the Fed stopped QT becomes pretty clear once you see that, right? Once you look at what's happening underneath the surface. So if we go back again to November, the funding markets were already telling you reserves were getting tight. John Williams from the Fed, he actually laid this out on November 7th. He said that the decision to end QT on December 1st was based on clear market-based signs that reserves had moved down from abundant toward what he called somewhat above ample. And when you listen to what he listed, it lines up with what we are seeing every day in the data, right? So you had repo rates drifting above the Fed's own target range. You had more volatility in those rates on certain days. And you had banks tapping the standing repo facility more often. Now, that's the kind of activity that usually shows up when the system is running low on reserves, low on liquidity. And if you go back and check the money markets around that same time, you can see it pretty plainly. In mid-November, short-term rates started trading above the ceiling that the Fed sets. So it's usually a sign that liquidity is getting way too scarce inside the system. Now, banks also started leaning in. We saw the Fed's standing repo facility, which is basically like the backstop when private funding isn't enough. And there were days where usage hit 15 billion, 20 billion, even 24 billion. Now, by the end of that month, now we haven't seen numbers like that since the COVID period. When the banks are pulling that much from the SRF, it usually means that they can't get overnight cash, right? The cash they need at normal levels in the open market. Now, Lori Logan, who remember used to run the New York Fed's entire market desk, she spelled it out in her October 31st speech. She supported stopping QT and said that if repo rates stayed elevated, the Fed would need to start buying assets again to keep reserves from falling too low. Now, when someone like her, right, with her background, says that publicly, it tells you the Fed knew they were pushing the system towards its limit. Now, Powell had already hinted at the same thing. So in October 29th in his press conference, he said that once QT ended, there would come a point where the Fed would have to expand its holdings again, expand its reserves, because reserves needed to grow with the size of the banking system. Now, that's not about stimulating the economy. That's just how the mechanics of the system work. And when you look at all of it, right, if you look at it all together, repo rates above the target band, the SRF usage hitting the highest level since the pandemic, Fed officials talking openly about asset purchases if the pressure continued, it's pretty obvious why they ended QT on December 1st, right? The tightening cycle had run its course. Reserves were getting scarce, and the plumbing was now starting to break, all right? That's why they had to stop. And when the Fed hits that point, the next phase is usually the same. Liquidity has to come back in. That's what they're trying to fix.
The events of late 2019 through 2021 illustrate how deeply financial markets are influenced by central bank policy and liquidity conditions. As quantitative tightening drained reserves, short-term funding markets began to show stress. Repo rates moved above the Fed's target range, and banks increasingly tapped the standing repo facility at levels not seen since the pandemic. These signals made it clear that the system required intervention. Once QT ended and liquidity began flowing back into the system, risk assets across the board from stocks and tech to gold and Bitcoin reacted strongly, each reflecting its sensitivity to the surge in available capital. This sequence demonstrates a consistent pattern: the health of money markets, the functioning of the banking system, and the performance of major asset classes are all interconnected, with liquidity serving as the critical driver. Understanding these dynamics provides a roadmap for anticipating future cycles and preparing for the next phase of market movements. How might the next phase of Fed-driven liquidity impact different asset classes, and which sectors are likely to respond most strongly? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.